Hey everyone, Simo here from Simo Equity Research. Welcome back to the channel. Today we're doing a full analysis that I know a lot of you have been requesting. SCHD versus VOO versus VTI. The three titans of passive investing. We're going to break down 10 years of performance data, look at how they held up during the crash of 2020 and the brutal bear market of 2022. And most importantly, we're going to talk about something that nobody seems to address properly, tax efficiency. Because here's the thing, it's not just about returns. It's about what you actually keep after Uncle Sam takes his cut. Let me start by level setting what these three funds actually are, because I think a lot of people don't fully understand the structural differences. VOO is the Vanguard S&P 500 ETF. 500 large cap US companies, market cap weighted. This is as close to a pure play on American capitalism as you can get. Apple, Microsoft, Nvidia, Amazon, these are your heavy hitters. VOO launched in 2010 and it tracks the S&P 500 index with surgical precision, expense ratio of 3 basis points, that's dirt cheap. VTI is the Vanguard Total Stock Market ETF. Now this one launched way back in 2001 and it tracks the CRSP US Total Market Index. We're talking about over 3,600 stocks here. Large cap, mid cap, small cap, micro cap. The entire investable US equity market, about 82% of VTI is actually large cap, which means roughly 82% of VTI overlaps with VO. The other 18% is where you get your mid and small cap exposure. VTI also has a 3 basis point expense ratio, same cost as VOO. Now SCHD, this is the Schwab US Dividend Equity ETF, and it's a completely different animal. SCHD launched in late 2011 and it tracks the Dow Jones US Dividend 100 Index, only about 100 holdings. But here's what makes SCHD interesting. It's not just a dumb dividend fund that buys the highest yielders. SCHD uses fundamental quality screens, return on equity, dividend growth rate, cash flow to debt ratios. It's selecting for profitability, for investment quality, and for companies that have a demonstrated track record of not just paying dividends but growing them consistently over time. SCHD has a 6 basis point expense ratio. Twice as expensive as VOO and VTI, but still incredibly cheap in the grand scheme of things. From a sector allocation standpoint, VOO and VTI look pretty similar. Heavy tech weighting, around 30% or so. Healthcare, financials, consumer discretionary, industrials. Standard broad market exposure. SCHD is a whole different story. SCHD massively overweights consumer staples, financials and industrials. These are sectors known for reliable cash flows and strong profitability. And here's what's critical, SCHD has virtually zero exposure to utilities and real estate. It also significantly underweights technology compared to the broader market. So right off the bat, you need to understand that SCHD is not a core holding. It's a tilt. It's a bet on quality dividend growth and factor exposure to profitability, investment and value. All right, let's talk performance. And I'm going to give you the numbers straight because this is where it gets interesting. Over the past 10 years, from SCHD's inception in October 2011 through today, VOO has delivered an annualized return of approximately 14.6%. VTI has delivered around 14.4%. SCHD has delivered about 11%. So on a pure total return basis, VOO wins. VTI is a close second. SCHD lags by roughly 3 to 4 percentage points annualized. Now before the SCHD fans come after me in the comments, let me explain what's happening here. In 8 out of the last 10 years, VOO outperformed SCHD, and in 2023 the outperformance was massive. VOO crushed it with over 21% outperformance versus SCHD. Why? because 2023 was the year of the Magnificent Seven. Tech mega caps went absolutely parabolic. SCHD doesn't own those companies in the same concentrated way that VOO does, so it got left behind. But here's where I want you to pay attention. Year to date in 2025, as of early November, VOO is up about 17.5%. VTI is up around 16%. SCHD is basically flat, up less than 1%. Again, this is a tech-driven rally. The S&P is being pulled higher by a handful of megacap tech names. SCHD just doesn't participate in that story the same way. However, and this is critical, we need to look at risk-adjusted returns. SCHD's maximum drawdown since inception was negative 33.37%. VOO's maximum drawdown was negative 33.99%, nearly identical. VTI's drawdown was in the same ballpark, so SCHD is taking on basically the same level of downside risk as VO and VTI, but it's delivering lower returns. That's a problem from a Sharpe ratio perspective. Over the last 12 months, VOO's Sharpe ratio is 1.16, VTI's is 0.93, SCHD's is negative 0.1. That tells you VOO is delivering better risk-adjusted returns right now. Now let's talk about the two major stress tests of the last decade. The COVID crash of March 2020 and the bear market of 2022. In March 2020, everything got hammered. Bonds, stocks, commodities, everything. SCHD, VOO, and VTI all dropped around 30 to 35% peak to trough. There was no meaningful difference in downside protection. However, the recovery was interesting. VOO and VTI bounced back faster because of their tech exposure. Remember, 2020 was the year of stay-at-home stocks. Zoom, Netflix, Amazon, Apple. These companies exploded higher. SCHD lagged the recovery because it didn't own those names in size. Then we get to 2022. This was the year that broke a lot of narratives. Rising interest rates, inflation fears, the Fed hiking aggressively. Both stocks and bonds got crushed. VOO was down about 18% for the year. VTI was down slightly more because small caps got hit harder. And here's where it gets interesting. Some people claim SCHD held up better in 2022 because of its quality factor tilt and dividend focus. The data shows SCHD was down in the low to mid-20s percentage-wise for the year, so it actually underperformed VOO in the 2022 bear market. The narrative that dividend stocks provide downside protection didn't hold up. Why? Because SCHD is still 84% correlated with the broader market. It's not a bond. It's not a hedge. It's a stock fund with a quality tilt. And in a systemic risk-off environment, everything goes down together. Now let's get into the part that really matters for long-term wealth building. Tax efficiency. This is where the rubber meets the road and frankly, where most people get it completely wrong. All three of these funds are ETFs, which means they benefit from the in-kind redemption mechanism that makes ETFs inherently more tax efficient than mutual funds. But there are important differences in how dividends are treated. Let's start with dividend yield. SCHD's trailing 12-month dividend yield is around 3.86%. VOO's yield is about 1.12%. VTI's yield is around 1.15%, so SCHD is paying out more than 3 times the dividend yield of VOO or VTI. Now, if you're retired and living off dividend income, that might sound attractive, but if you're accumulating wealth, especially in a taxable account, this is a tax drag. Here's why. SCHD's dividends have been 100% qualified in recent years. That's good. Qualified dividends are taxed at long-term capital gains rates, which for most people is 15%, and for high earners it's 20% plus the 3.8% net investment income tax. VOO's dividends are also 100% qualified. VTI is about 95 to 96% qualified because of its small cap exposure and some REIT dividends that get classified as non-qualified. So from a qualified dividend perspective, all three are pretty tax efficient. But the problem with SCHD is volume. You're getting 3.86% in dividends every year, whether you want it or not. If you're in the 15% qualified dividend tax bracket, that's about 58 basis points of your return going to taxes annually. If you're in the 20% bracket plus NIIT, you're looking at closer to 92 basis points every single year. Compare that to VOO. You're only getting 1.12% in dividends. At a 15% tax rate, that's about 17 basis points in annual tax drag. At 23.8%, it's about 27 basis points. Over 10, 20, 30 years, this compounds significantly. The difference between a 58 basis point annual tax drag and a 17 basis point tax drag is enormous when you factor in compounding. And here's the other piece. When you hold VOO or VTI, you have control over when you realize capital gains. If you need cash, you sell shares and you choose when to take that gain. With SCHD, the fund is forcing you to take income every quarter via dividends. You don't get to control the timing. That's a loss of optionality. Now, let me address the counter argument because I know some of you are thinking it. What about reinvesting the dividends? Doesn't SCHD's higher yield give you more capital to reinvest and compound? In theory, yes. And if you run a hypothetical model where you reinvest all dividends in a tax-advantaged account like a Roth IRA or a 401k, SCHD can actually look quite compelling because there's no tax drag. The higher yield compounds without friction. But in a taxable account, which is where most people hold these funds for long-term wealth building, the tax drag on those dividends erodes your compounding. Let me give you a real-world example. Let's say you invest $100,000 in SCHD versus $100,000 in VOO, both in a taxable brokerage account. You hold for 10 years and reinvest all dividends. After accounting for taxes on dividends each year and assuming you're in the 23.8% rate for qualified dividends, SCHD's higher yield advantage gets mostly neutralized by the annual tax bill. By the time you hit year 10, VO is likely ahead because you've been compounding more efficiently without the annual tax bleed. And if tech continues to outperform, which it has for most of the last decade, VOO pulls even further ahead. There's one more tax consideration that people don't talk about enough: capital gains distributions. All three of these funds, SCHD, VOO, and VTI, have been extremely clean on this front. SCHD has never made a capital gains distribution. VOO and VTI have also been very clean. This is one of the big advantages of index ETFs over actively managed funds. So on that metric, all three are winners. All right, let's talk about portfolio construction because this is where I think the conversation should really focus. The question isn't necessarily which one is best in isolation. The question is, how do you use these tools to build an optimal portfolio? If you're looking for a single core holding that you're going to own for 20 or 30 years and never touch, VOO or VTI are the obvious choices. They give you broad, diversified exposure to the US equity market at rock bottom cost. VOO is pure large cap. VTI adds mid and small cap exposure. Historically, the performance difference has been negligible. VOO has slightly edged out VTI over the last 10 years, but that's mostly because large caps have dominated. If you believe small and mid caps will have their day, VTI gives you that exposure. Personally, I lean toward VTI for total market coverage, but you really can't go wrong with either. SCHD is different. SCHD is not a core holding, it's a tilt. If you want to overweight quality, profitability, and dividend growth within your equity allocation, SCHD is an excellent way to do that. but you should view it as a satellite position, maybe 10 to 20% of your portfolio, with the bulk in something like VTI or VOO. The other thing to consider is account type. If you're going to hold SCHD, put it in a tax-advantaged account. Roth IRA, traditional IRA, 401k, let that higher yield compound tax-free. In your taxable account, stick with VOO or VTI, where you have more control over the timing of your tax events. Here's my personal take, and this is just my opinion based on the data. For most investors building wealth over the long term, VTI or VOO should be your primary holding. They're cheap, they're diversified, they're tax efficient, and they've delivered exceptional returns. If you want to add a dividend growth tilt for diversification, or because you like the quality factor exposure, add SCHD in a tax-advantaged account. But don't make SCHD your core. And definitely don't chase yield for the sake of yield. Yield is not free money. It's just a different form of return, and in a taxable account, it comes with a cost. Now, one last thing I want to mention. None of these three funds give you international exposure. They're all US equity. If you believe in global diversification, and I do, you should be complementing any of these with something like VXUS or VEA for developed international markets. But that's a topic for another video. So to wrap this up, VOO and VTI are neck and neck for long-term core holdings. VOO is pure S&P 500. VTI gives you total market. Both are phenomenal. SCHD is a quality dividend growth tilt that works best as a satellite holding in tax-advantaged accounts. From a tax efficiency standpoint, VOO and VTI have the edge in taxable accounts due to lower dividend yields. And from a pure performance standpoint over the last 10 years, VOO takes the crown, followed closely by VTI, with SCHD trailing due to its underweight in mega-cap tech. That's my analysis. If you found this breakdown helpful, hit that like button and subscribe to the channel. Drop a comment below and let me know which of these three you're holding and why. I read every single comment. And as always, this is not financial advice. Do your own research, consult with your financial advisor, and invest based on your personal situation and risk tolerance. Thanks for watching. This is Simo from Simo Equity Research, and I'll see you in the next one.